Budget Committee Social Security Task Force met to talk about the state of the trust fund and to suggest improvements in the current program. Federal Reserve Board Chairman Alan Greenspan and officials from the General Accounting Office give their assessments. New Hampshire Senator Judd Gregg calls the 1.5-hour meeting to order.
We'll get started. This hearing is now called to order. This is a special task force of the Budget Committee set up by Chairman Domenici, which is to look into the issue of the Social Security Fund and its impact on the future budgets of the United States. It's a great pleasure, obviously, to have joining us today as our leadoff witness, certainly the leading authority, or one of the leading authorities, but the leading authority on how to correct the Social Security system, since he's done it once, the chairman of the Fed. And I also very much appreciate Senator Grassley joining us for the hearing. The membership of the committee involves myself, Senator Hollings, who's the ranking member who can't be here today, Senator Conrad and Senator Wyden, Senator Gorton, Senator Grassley. And we intend in this hearing process to first outline the issue as it is seen and its the projected problems, and to secondly try to come up with some solutions. I think at the outset it's important to point out that the Social Security system is a critical element of the American fabric, and that it is our intention to maintain the Social Security system as a viable and vibrant part of the American system of retirement, but that the system is confronting some very severe problems in the out years, and that in order to address those problems, it is better to start now than to wait. It's a lot like the Fram oil filter ad. You can pay me now or you can pay me later. In this instance, the sooner we get about the business of addressing the demographic shift which is going to occur in this country as the post-war baby boom generation, the generation of Bill Clinton, hits the system beginning in the year approximately 2010, and thus creates a tremendous drawdown on the system when we go from 3.5 workers today paying into the system to two workers paying into the system by the year 2020. In order to address that issue of the demographic revolution that is coming, it is better to start now than to wait. It's as if you could predict, in this instance, a date of a major hurricane or a major flood or a major volcanic eruption. You know the date, you know the time, you know the place, you know the catastrophic implications of it, in this case fiscal implications and personal implications of this system being confronted with this huge increase of people coming onto it. As a government, we would obviously fail if we did not get ready for such a physical event, such as a hurricane, flood, or volcano that we knew the date of. And as a government, we will also fail if we don't get ready and plan and begin to address the issue of the Social Security system as it confronts this expansion of benefits required, expansion of participants required to be paid as the post-war baby boom generation hits the system. So that's what we're going to talk about, and we hope to come up with specific ideas. This is not going to be just a presentation of the problem. This is going to be an attempt to put on the table some ideas from which we can launch some solutions. And so again, I very much appreciate our first witness, but before turning to our first witness, I would ask if the senator from Iowa has some comments. I know he's on a tight schedule and has to address some other issues with some other colleagues.
Yeah. I do have an opening statement I would like to make. I would like to, first of all, congratulate you for heading up the Budget Committee's efforts to examine the challenges that face the Social Security system, and I fully endorse the direction that you have chosen as chair of the task force, and particularly making Social Security and finding the source of trouble and doing something about it as the first priority of the committee. I also commend you for introducing legislation months ago on this issue. You took the direction of introducing legislation to bring about some sort of a national conversation to lead to a national consensus on what to do about Social Security. Too many of us, including this senator, being guilty of trying to focus on a consensus but not introducing a specific piece of legislation, and sometimes maybe being a little too nervous about introducing legislation on a politically sensitive issue until there is a consensus. So you have indeed taken a pioneer approach, and you need to be commended for that. The General Accounting Office, which will be heard from, has done an extensive work in this area, and their research will provide credibility to the recommendations that this task force will be making next year. And as chairman of the Aging Committee of the United States Senate, I want to look at the testimony that comes out of the work of this task force as well. To the extent that we can utilize the findings of the General Accounting Office and this committee and broadcast those findings to our colleagues and the public at large, I think we're more apt to achieve success, because we achieve a consensus on a politically sensitive issue. Our second priority is looking at various reforms that have been proposed. Some proposals take the approach of maintaining the structure of the current system and focus upon the financial woes. Other proposals are much more ambitious. They take the approach that the system is unsustainable without structural reform. We need to begin making some headway to describe reform options to the public and identify the trade-offs which are associated with those options. As we review various options, I think it is important to remember that our constituents do not have the benefits of hearing objective Social Security experts talk about the challenges, the problems faced on a regular basis, as we seem to on the Hill or in Washington generally. Our constituents must rely on news articles or interest group mailings, which often don't present the full picture, and some of them are outright demagogic about the whole issue. There is still much to be done to raise the awareness of the affected public, and I think this hearing helps do that. During this process, we need to emphasize 2 points: the reasons for Social Security fiscal problems, and that Social Security's insolvency is only one threat to the retirement security in this country, because Social Security is only part of the Social Security plan that each people ought to have. It's one of a three-legged stool with pensions and with private savings. Of course, there are some people who are way ahead of the curve in resolving the Social Security dilemma. Just this summer, we enacted the Balanced Budget Act of '97, putting the country on a course to have a zero deficit by the year 2002, and hopefully it happens way before then if the economy continues as it has. Just a short time after the passage of the act, we heard that economists in investment houses in our bigger cities were predicting much lower budget deficits sooner than we thought realistic. Not long after, then legislation was introduced proposing a variety of uses for any of the subsequent surpluses, even before they're in hand, which is a little too jovial approach to take, considering the reality of Washington, D.C. One proposal would contemplate using any surplus to begin paying off the long-term promises that we have made to American workers and their families. It seems to me that that's something that this task force would be considering, since Social Security trust funds will add to the unified budget surplus contributions of more than $80 billion in the year '99. This would not be an irrational approach. I would suggest that first, running a budget surplus may not be a bad thing. Second, if we do choose to utilize the surplus, and if we don't start funding the current unfunded Social Security promises, then of course public cynicism, which is something that we don't give enough consideration to in this town as we try to make policy, but public cynicism is also going to be brought to bear on the trust fund accounting that will continue, cynicism will continue to grow if we don't level with the people. Unfortunately, as you said, Mr. Chairman, I'm going to have to go because I have a discussion on health care before the National Coalition of Health Care downtown. I should be staying here to hear Chairman Greenspan, because his testimony is very good, particularly as it relates to the budget deficit forecast, the dilemmas facing the Social Security problem, and how he always emphasizes the need for national savings, which is very much a necessary part of this hearing when we try to find solutions to Social Security. And of course, most importantly, the problems that we face in scaling back entitlement spending to minimize the negative impact that will have on the economy in the future. Chairman Greenspan, I want to tell you that you've been in the trenches working to protect the Social Security program for a long time, and we have a sound program because of the work you did with the 1983 Commission, and you can share observations from those years to help us get ready for changes that need to be made for the future. It seems to me your testimony will be an invaluable source of information for this task force. So I thank you, Mr. Chairman, for allowing me to go ahead and for your leadership.
Thank you very much. And I will also include in the record a statement from Chairman Domenici and a statement from Senator Grams at this time. Now we'll turn to the Chairman of the Federal Reserve, who needs no introduction. In fact, if we were to use his resume, we would be here until the year 2010. Introducing him would be like introducing Babe Ruth to try to introduce the Chairman. So please, Mr. Chairman, just proceed.
Thank you very much, Mr. Chairman. I'm pleased to appear today to discuss one of the nation's most pressing challenges, putting Social Security's Old Age and Survivors Insurance Program on a sound financial footing for the 21st century. It has become conventional wisdom that the Social Security system as currently constructed will not be fully viable after the baby boom generation starts to retire. The most recent report of the Social Security trustees projected that the trust funds of the system will grow over approximately the next 15 years. However, beginning in the year 2014, the annual expected costs of the Old Age and Survivors Insurance Program are projected to exceed annual earmarked tax receipts, and the subsequent deficits are projected to deplete the trust funds by the year 2031. This imbalance in Social Security stems primarily from the fact that until very recently, payments into the Social Security trust accounts by the average employee, plus employer contributions and interest earned, were inadequate to fund the total of retirement benefits. This has started to change. Under the most recent revisions to the law and presumably conservative economic and demographic assumptions, today's younger workers will pay Social Security taxes over their working years that appear sufficient on average to fund their benefits during retirement. However, the huge liability for current retirees, as well as for much of the workforce closer to retirement, leaves the system as a whole badly underfunded. This issue of funding underscores the critical elements in the forthcoming debate on Social Security reform because it focuses on the core of any retirement system, private or public. Simply put, enough resources must be set aside over a lifetime of work to fund the excess of consumption over claims on production a retiree may enjoy. At the most rudimentary level, one can envisage households saving by actually storing goods purchased during their working years for consumption during retirement. Even better, the resources that would have otherwise gone into the stored goods could be diverted to the production of new capital assets, which would cumulatively, over a working lifetime, produce an even greater quantity of goods and services to be consumed in retirement. In the latter case, we would be getting more output per worker, a traditional measure of productivity, and a factor that is central in all calculations of long-term Social Security trust fund financing. In sum, Mr. Chairman, the bottom line in all retirement programs is the availability of real resources. the finance of any system is merely to facilitate the allocation of resources that fund retirement consumption of goods and services. Unless Social Security savings are increased by higher taxes with negative consequences for growth, or reduced benefits, domestic savings must be augmented by greater private savings or surpluses in the rest of the government budget to ensure that there are enough overall savings to finance adequate productive capacity down the road to meet the consumption needs of both retirees and active workers. The basic premise of our current largely pay-as-you-go Social Security system is that future productivity growth will be sufficient to supply promised retirement benefits for current workers. However, even supposing some acceleration in long-term productivity growth from recent experience, at existing rates of savings and capital investment, a pickup in productivity growth large enough by itself to provide for impending benefits is problematic. Moreover, savings borrowed from abroad, our current account deficit, cannot be counted on indefinitely to bridge the gap between domestic investment and domestic savings. Accordingly, short of a far more general reform of the system, there are a number of initiatives at a minimum that should be addressed. As I argued at length during the Social Security Commission deliberations of 1983, with only modest effect, some delaying of the age of eligibility for retirement benefits is becoming increasingly pressing. For example, adjusting the full benefits retirement age further to keep pace with increases in life expectancy in a way that would keep the ratio of retirement years to expected lifespan approximately constant would significantly narrow the funding gap. Such an initiative would become easier to implement as fewer and fewer of our older citizens retire from physically arduous work. Hopefully, other modifications to Social Security, such as improved cost of living indexing, will be instituted. There are a number of broader reform initiatives that, through the process of privatization, could increase domestic savings rates. Given the considerable stakes involved, these are clearly worthy of intensive evaluation. Perhaps the strongest argument for privatization is that replacing the current underfunded system with a fully funded one could boost domestic savings. But we must remember that it is because privatization plans might increase savings that they are potentially viable, not because of their particular form of financing. Moving towards a privatized defined contribution plan would by definition convert our Social Security system into a fully funded plan. But the same issues and questions remain as under the current system. What level of retirement income would be viewed as adequate, and should required contributions to private accounts and savings be increased to meet this level? Is there an alternative to forced savings to raise the level of contributions to the private funds? Finally, if individuals did invest a portion of their accounts in equities and other private securities, thereby receiving higher rates of return and enhancing their Social Security retirement income, what would be the effect on non-Social Security investments? As I have argued elsewhere, unless national saving increases, shifting Social Security trust funds to private securities, while likely increasing income in the Social Security system, will, to a first approximation, reduce non-Social Security retirement income to an offsetting degree. Without an increase in the savings flow, private pension and insurance funds, among other holders of private securities, presumably would be induced to sell higher yielding stocks and private bonds to the Social Security retirement funds in exchange for lower yielding U.S. Treasuries. This could translate into higher premiums for life insurance and lower returns on other defined contribution retirement plans. This would not be an improvement to our overall retirement system. Furthermore, the potential consequences of moving Social Security to a system that features private retirement accounts need to be considered carefully. Any move toward privatization will confront the problem of how to finance previously promised benefits. That would presumably involve making the implicit accrued unfunded liability of the current Social Security system to beneficiaries explicit. For example, participants at the time of privatization could each receive a non-marketable certificate that confirmed irrevocably the obligations of the United States government to pay a real annuity at retirement indexed to changes in the cost of living. The amount of that annuity would reflect the benefits accrued through the date of privatization. Under our current system, Social Security beneficiaries technically do not have an irrevocable claim to current levels of promised future benefits because legislative actions can lower future benefits. In contrast, the explicit liability of federal government debt to the public is essentially irrevocable. A critical consideration for the privatization of Social Security is how financial markets are factoring in the implicit unfunded liability of the current system in setting long-term interest rates. If markets perceive that this liability has the same status as explicit federal debt, then one must presume that interest rates have already fully adjusted to the implicit contingent liability. However, if markets have not fully accounted for this implicit liability, then making it explicit could lead to higher interest rates for U.S. government debt. For any level of real annuity at retirement, the corresponding current value of recognition certificates would depend on a number of technical assumptions. These assumptions have no impact on the real payouts from the retirement annuities, but determine the current notional value of recognition certificates, which is useful for making broad economic comparisons. For example, factoring in a 2% real annual rate of discount and including other technical assumptions, the value of recognition certificates the U.S. government would need to issue to ensure that all currently accrued legislated future benefits are paid would be roughly $9.5 trillion. Alternatively, at a 1% real rate, the value would be roughly $12 trillion. And at a 6% real rate, the value would be $4.5 trillion. Because under a wide range of assumptions, the magnitude of this liability remains very large relative to the current outstanding federal debt to the public, that is $3.5 trillion. The market adjustment could be substantial. There is reason to suspect, however, that if such a liability is made explicit in a manner similar to the transition procedure in Chile, each dollar of new liability will weigh far less on financial markets than a dollar of current public debt. In the case of the Chilean pension reform, a significant portion of the implicit liability of their old system was made explicit at the initiation of the new pension system by the issuance of so-called recognition bonds. that were deposited in workers' individual accounts. These bonds were initially non-marketable, indexed for price inflation, and yielded a fixed real return on a specified face value. In Chile, the liquidation of these bonds generally occurs only after a worker retires and the proceeds from the bonds are required to be paid in the form of an annuity or through programmed partial withdrawals. These bonds have been viewed as a different instrument from other forms of public debt, and it is likely that if an instrument such as recognition certificates were issued in the United States, it also would be viewed as distinct from fully liquid, marketable public debt. In effect, under privatization, the obligations of Social Security would be transferred from an implicit government account to millions of private individual accounts. Retirement needs would be funded first by the conversion of recognition certificates and later by withdrawals from private defined contribution funds. The outstanding certificates would accordingly decline with time and finally be paid off some decades in the future. But if benefits and contributions do not change, national savings are only being transferred from the federal government account to that of households and are not increased in the process. It is only if contributions or private saving increases that household and national saving increases. That household and national savings increases. The transfer of savings from public to private accounts would affect the unified budget balance of the United States government, although precisely how that balance would be affected would depend on the exact budgetary accounting treatment adopted for recognition certificates. Certainly with immediate and full privatization, the ongoing annual unified budget balance would decline by at least the amount of the Social Security surplus. As payroll taxes were diverted from public coffers to private accounts, they would no longer count as tax revenues. Similarly, payments of Social Security benefits would not count as outlays. The issuance of recognition certificates under current accounting rules presumably would also increase outlays and the deficit by the value of the certificates at the time of issuance. Exactly how much the deficit would be affected in the initial year and how much in subsequent years would depend on how the certificates were structured and on bookkeeping conventions. However, the basic effects of privatization on the budget deficit are clear. The implicit liabilities of the Social Security system would start to appear on our balance sheets now rather than when the baby boomers retire. It is an open but crucial question as to how financial markets would respond to a change of the magnitude contemplated by immediate full privatization. Before any such move is made, a thorough examination of the risks and benefits to the financial markets would be wise. The key issues that will affect the economy are: one, the change from the implicit liability of the current system to one of an irrevocable obligation to pay, and two, the magnitude of changes in national saving and the level of productivity spurring investment. The budget bookkeeping on how privatization is recorded has little significance. An alternative to what is clearly a big bang, one-shot transition in which privatization occurs immediately for all is a gradual transition where, for example, only younger workers are accorded recognition certificates and are required to fund the remainder of their retirement needs through defined contribution plans. Over the years, ever older groups would be included in the new system. During the transition, two systems would operate in parallel. Such a transition would involve smaller immediate increases in recognition certificates and in the unified budget deficit, and smaller accompanying market risks, but would have larger effects in subsequent years as tax revenues from the younger groups would be diverted as contributions to private accounts, whereas all Social Security benefits to retirees would still be counted as government outlays. Thus, if there is a unified budget surplus before the transition, it will be reduced or turned to a deficit at least to the extent of the loss in tax revenues. In effect, Social Security benefits will be increasingly financed by so-called general revenues for a time. Should this be the direction that the Congress decides to move, containment of spending outside of Social Security doubtless would be necessary to add assurances to the market. Ultimately, of course, even under a gradual transition, the system would be almost fully privatized. I say almost because I presume Congress would provide some form of assistance to those who, through investment imprudence or unforeseen events, had retirement benefits below a certain level perceived as an absolute minimum. Needless to say, Mr. Chairman, such a new entitlement would have to be rigorously delimited because political pressures to increase it could be overwhelming. Despite all of these complications in the broader scheme of things, the types of changes that will be required to restore fiscal balance to our Social Security accounts are significant but manageable. More important, most entail changes that are less unsettling if they are enacted soon, even if their effects are significantly delayed, rather than waiting 5 or 10 years or longer for legislation. We owe it to those who will retire after the turn of the century to be given sufficient advance notice to make what alterations in retirement planning may be required. If we procrastinate too long, the adjustments could be truly wrenching. Our senior citizens, both current and future, deserve better. Mr. Chairman, I request that my full remarks be included for the record.
Thank you very much, Mr. Chairman, and that was certainly a statement that has a tremendous amount of thought-provoking initiative and ideas in it, and obviously your full statement will be included in the record. Can I start with a couple of preliminary questions? Just to restate what you said at the end, it's your belief that if we act sooner rather than later, we've got a better chance of addressing this issue?
I think, as we're all acutely aware, Mr. Chairman, that endeavoring to adjust any form of benefit structure in which the impact is immediate creates very considerable uncertainty in beneficiary recipients. And the consequence of that is that you create a degree of both legislative and political turmoil which makes it very difficult to get reasonable legislation. There are a lot of changes that are going to have to be made one way or the other, if for no other reason, to address the types of problems you're showing in those charts. And it's pretty evident that the sooner we know what they are, the sooner that retirees pending and current know what they are, the the better off everyone will be, especially those who have to be involved in planning for their future retirement. It strikes me that there is no reason why we cannot put into place legislation today which may not become effective for 10 years. It is far easier to pass that legislation in a sensible manner with due deliberation today than waiting for another 5 or 8 years and then find out being up against the gun of a very seriously underfunded system trying to repair it. Short-term repairs are precisely that. They are short-term. What we need now is a long-term adjustment which will continue the retirement capabilities of our system well into the 21st century in a manner which I think the American people would very much like to see us do.
That being the case, and presuming you control the magic wand and could create the legislation today, I take it would be a mixture of benefit adjustment from what you've just told us in the area of retirement age being scaled up and the CPI being accurately calculated, and some sort of attempt to expand savings using these recognition certificates. Could you just sort of give us a, if you were to write the legislation for the that would occur in 10 years, what would it be? In quick oversight summary.
I've argued in the past at great length that the retirement age is got to be adjusted, because when the Social Security system was first put in place back in the 1930s, the general presumption was that the retirement age of 65 was one which a lot of people would never reach, and if they reached it, wouldn't be around for very much longer. And so the costs of the system as envisaged then on the pay-as-you-go basis largely seemed very easy to fund. Fortunately, life expectancy has been extended very appreciably, way beyond what would have been contemplated either by the originators of the Social Security legislation in the mid-30s and even in the early post-World War II period. What has occurred, obviously, is that the ratio of years in which people receive benefits has increased quite measurably relative to the number of years they were working and putting monies into the funds. The simple solution to this is to alter the retirement age to keep those working retirement years in some credible balance. As you know, Mr. Chairman, the major argument against that has largely been that people retiring from significantly arduous work really couldn't extend their working lives particularly, and really had to retire early. One of the great advantages of the changing technologies is that the degree of truly arduous work is declining very materially in this country. And as a consequence, I should think that it should not be a terrible burden on the senior population to link that in a manner that clearly would very materially reduce the problems of funding a gap between contributions and benefits. I've gone on at length in other discussions before this committee on the cost of living adjustment, and I won't dwell on it. But as you know, it's the judgment of the Federal Reserve staff, and indeed a substantial part of the economics profession, that the Consumer's Price Index is over measures the rate of increase of the cost of living, the true cost of living. The BLS has made a number of changes recently, and that's improved it, but we still have a good way to go. and I would still argue in favor of some form of adjustment in the Consumer's Price Index to get it closer to a cost of living index for Social Security indexing purposes. Over and above this, there are clearly questions as to whether we can change the whole system in a manner in which I was discussing in my prepared remarks, that is, moving either gradually or fully to a privatized system with some form of backup for those who fall through the safety net.
Well, following up on that point, and I'm interested in pursuing that for a second here. The basic theme, I think, was that you can't privatize the system and expect it to be a positive event unless you are increasing savings generally. Is that correct?
If the general purpose is to increase the aggregate amount of retirement incomes from all of the various segments of how the population draws from it, if you don't increase savings, you effectively cannot pay in real resources without a major drain on the system the types of benefits which are now embedded in current law.
And if that's the case, then the question becomes, how do you increase savings in the process of moving towards this privatization? And I guess one question I have is, as we see a projected surplus moving into the future here for the federal government, which surplus ironically almost mirrors what the real surplus is in the Social Security system, about $30 billion. Would it be appropriate to use that surplus for the purposes of energizing additional savings?
Well, the savings are already there in the form of the surplus. In other words, since it's the national savings that we're interested in, that is a combination of household, business, and government savings. So the mere accumulation of a federal budget surplus, unified budget surplus, in effect is creating the savings which can flow into the private sector's capital investment accounts. So using the surplus for solving the Social Security savings problem is a wash. In other words, it's merely a transaction which could conceivably increase household savings, but would reduce government savings by exactly the same amount. And it wouldn't come to grips with this particular concern that I have about the nature of maintaining a level of savings, investment, and productivity growth which can maintain the degree of real resources required for both workers and retirees well into the 21st century.
So, in layman's terms, what would be your way in which to accomplish that?
You can increase savings by a number of different ways. In a number of proposals, as you're aware, Mr. Chairman, there is either explicit or de facto forced savings. I mean, those, for example, who talk about allocating part of the Social Security taxes to private account are effectively talking about forced private savings. You're not paying the taxes to the federal government into the Social Security Trust Fund. You're putting it into your own account, but those monies are immobilized by law so that they can be used only at retirement. That's effectively forced savings. There are more explicit...
Excuse me, but at that point, but for that to accomplish your goal, which is to increase the savings effort, that forced savings would have to exceed the surplus.
No, it's all it has to do. It would effectively, it would have to, some way or another, increase the aggregate amount of contributions into the privatized or other Social Security funds, whether it's private or public. And obviously, if you increase the contribution rate against taxable income by 2 percentage points, you'd close the gap according to the most recent projections of the Social Security trustees. There are other means of doing it. I mean, clearly, were we able to find a mechanism by which, through tax incentives, we could increase the overall savings, that would be the equivalent. The only concern I have with that is we've tried a lot of them, and it's not clear the extent to which, say, 401ks or other types of investment funds increase savings net. I'm sort of encouraged in part because most recent analytical work, academic work in that area, is suggesting that it may indeed be increasing the savings rate. The trouble, unfortunately, as you know, is that against all the various different types of tax initiatives to increase the savings rate, the overall household savings rate has been going down for years, so that whatever it is we are doing is clearly not enough to even stem the rate of decline.
You don't sense, just an aside on that point, you don't sense that as a result of this huge baby boom generation seeing retirement over the hill 10 years, 15 years out, that a lot of the increased activity in investments in mutual funds and stocks and bonds is a function of that generation starting to shift from being a consumption generation to a savings generation?
Yeah, I think that's probably likely. It may very well be that what is masking the data from showing that is this huge increase in stock market wealth, which history tells us tends to reduce the savings, the amount of savings out of income. In other words, if you got large capital gains, the perceived need to save out of income is reduced, and what we measure as household savings is only the savings out of income, not out of capital gains. So it may very well be that, in fact, I suspect it is the case, that the underlying trend of savings may in fact be turning for precisely the reasons you say, Senator.
I can only speak for myself and a few friends who have turned 50 and suddenly feel we better start saving.
Yeah, I think that is a real effect. I think it's a very important effect and very desirable, unquestionably.
To get back, though, to this core issue, which is basically how you pay the transition cost. If we are running a surplus as a government, and we have a choice of using that surplus in order to finance some portion of a privatization of the Social Security Trust Fund, or we have a choice of using it for spending on social service, or alternatively for spending on capital activity, I take it your position is that that's a wash? It does not matter?
Well, no, it matters. If you use the surplus for new expenditure programs, that reduces the level of national savings. And I think that would run counter to the thrust of where I think we ought to be going. The wash would occur only to the extent that you're moving savings from the government sector, which is what a surplus is, to the private sector. That's a transfer. It doesn't increase or decrease national savings. And I frankly think that we ought to not be looking at the issue of the unified budget surplus as significantly related to any Social Security transition to privatization. It actually hasn't any significant impact other than cosmetics of how the deficits and budgets look. But from an economic point of view, it's not something I think we ought to focus on.
Now, on these recognition certificates, I listened to your explanation. To tell you the truth, I didn't fully understand it. Could you give me sort of a layman's explanation of how this transition would work with recognition certificates?
Yeah. I mean, supposing I am 40 years old, and I got 25 years before expected retirement or whatever. And tomorrow we go to full privatization. I will get in the mail, hopefully sooner rather than later, a certificate which would basically say that in the year 25 years or whenever from today, the United States government from that point forward will pay into the account of whoever it is X number of dollars a month throughout the remainder of one's life. That number would basically be, I should say, the value at the point of retirement would be an amount of money which would be able to purchase an annuity to fulfill that government obligation. How you would calculate what that amount of money is one, look at the accrued Social Security benefits that I have developed over my working life through the age of 40, where I'm supposed to be now. I'm really 39.
I can tell.
If you go to that point and then you say, what would be under existing law the retirement benefit at the point of retirement, you would make the following calculations. We would know what the accrued benefits are. We know what the wage history is. The only thing we have to do to exactly replicate the existing Social Security system is make a forecast of real national wage growth. Now that can vary a little bit, but it's not going to be a hugely different type of number. That will give you a calculation of what the required annuity would be, or the cost of purchasing an annuity would be in 1997 dollars. The final part of the calculation would be to adjust it for changes in the cost of living between today and 25 years from today, so that in effect that certificate would have significant value to the individual. It is different from what he has today, which is a general promise on the part of the federal government to pay, but as we are acutely aware, we can continuously make adjustments to that through legislation. What the certificate will offer is an irrevocable commitment, as indeed we would have to do if you're switching the system, and that would have a different status than the existing commitments that exist.
I guess it raises two questions for me. I'm sure it raises a lot of questions if I understood it better. But the two questions I would have would be, one, what is the substantive difference between that and what we do today, assuming no benefits changes occur? Because, of course, from a political standpoint, the integrity of the system is there, and it'll be there 20 years from. Something's going to be done to pay the debt. Assuming there was no benefit change, I would think in order to have a substantive impact, for this to have a substantive impact, it would have to generate some higher return. There would have to be some way that you were anticipating that going to this type of a recognition certificate would allow the investors of the money, if there was a fund or something, to get a higher return.
There is no fund.
Right.
It's merely a promise to pay. There is no fund that is related to it.
So it doesn't in any way alleviate the fact that you're not getting, that there's no, somebody's going to have to pay a tax in the year 2025 to pay off this certificate, and the tax is still going to be just as high whether you had the certificate or didn't have the certificate.
No. First of all, let's assume, let's go into a little more about what happens. assume that at the age of 40, at the point at which the privatization, forget whether there's privatization, assume I retire at the age of 40 and I do nothing, just read books. At the age of 65, I start getting Social Security. That's an annuity. The certificate that I'm referring to will grant the same level of benefits as is implicit in current law.
Right.
The issue of how that is financed is really an issue of bookkeeping. We haven't financed the Social Security system since its beginning. We have been grossly underfunded. We don't, in fact, build up the resources that will generate the benefits as a private, fully funded insurance system would do. The only thing that changes, if the only thing that happens is that the certificates are issued and we stay with the current system, which one could conceive of doing, all we have done is locked in the current law indefinitely into the future with respect to benefits. What I'm saying is that we're not, the same problems that we have in financing that certificate, so to speak, we have today. Nothing changes in that regard. We are not, in that sense, getting enough taxes into the Social Security trust funds to pay off those benefits. So the certificates per se don't solve that problem, don't address it, and really has nothing to do with the funding question. The issue that we're dealing with is merely what would one do if you shifted from public accounts to private accounts, and what is required to do that. And it all comes down to the need to raise the savings rate, but that's the same thing we would need to do even if we had continuation of the existing program. So far as the economics are concerned, nothing changes. The only difference is that it is likely that if you went to a private system, the inclination to save privately and contribute to one's retirement accounts is probably significantly above what we're getting in the current system. So there is, in one sense, much less of a change than a lot of people are talking about when you go to privatization, because the problems are essentially the same. You have to deal with them one way or the other. As I point out in my prepared remarks, merely allowing Social Security to be funded with private securities, whether it's a private fund or private securities held in the public Social Security trust accounts, really is partial illusion for solving the long-term retirement benefits of the system, because you're playing a zero-sum game. If you get a higher rate of return in Social Security, you're going to get a lower rate of return in other private systems. So the point that I think that is important here is that there are benefits in going to privatization. Those benefits, in my judgment, are that it increases the overall savings rate. I think it solves the underfunded type of problem that these data show over the longer run, provided the savings increases occur. And it's a much more viable system than what we have. But it does not create miracles. It doesn't create something out of nothing. Unless you save, invest, and increase the total amount of real resources in the 21st century. I don't care what type of financial system you devise. I don't care who owns it. All you're doing is shuffling paper. You're not producing real goods. And it's real goods that is what retirees require, not pieces of paper.
Well, I think that's a superb summary of the issue, and I thank you for it. You've been very kind to give us a considerable amount of your time this morning, and I very much appreciate you taking the time to come by. And as we move forward to trying to evolve some public policy resolutions of this, I hope you'll allow us to send them down to you and get your comment on them.
Well, we'll be of any help we can, Senator, and I think you're on a very important mission for this nation, and I can say I and my colleagues certainly wish you and your colleagues well.
Thank you very much, Mr. Chairman. The next panel. Do you have a list of the people? Aren't there 3 people? We have the pleasure now of having as our second panel the keepers of the numbers. Ms. Boberg is the Associate Director for Income Security Issues for the U.S. General Accounting Office. And in that capacity, she's overseen work on retirement income issues, the Social Security Administration management, income maintenance programs, including supplemental security income and temporary assistance for needy families. And we very much appreciate her taking the time to testify today. And Francis Mulvey, who is the Assistant Director with the United States General Accounting Office. And he has authored or directed over 50 reports and has prepared 50 congressional testimonies, primarily on issues of transportation, but since 1996 he's focused on Social Security and the pension issues. So we very much appreciate you taking the time to come by today, and know that you have some substantive data to give us, which will be helpful as we pursue options for trying to address this issue. So please, whoever's going to go first, go.
I'll be going first, Senator.
Okay.
Thank you. Mr. Chairman, the task force, we're pleased to be here today to talk about Social Security financing reform, especially in such august company. I feel that Dr. Greenspan is a very hard act to follow, but I'll do my best. I also wanted to introduce Ken Stockbridge, who's an evaluator from Income Security, who's accompanying us. The Social Security program affects virtually all American families. The program pays benefits to 44 million retirees, disabled workers, and their families, and it promises benefits to more than 70 million workers. As you said earlier, Senator, no other public program could be considered more central to Americans, so it's crucial to maintain Social Security's financial stability. Today, I'd like to discuss demographic trends that contribute to the financing problem, how these factors affect the federal budget, and approaches for addressing the problem. My testimony today is based on work that we've done over the past few years, most notably based on a report that we prepared at the request of Senators Grassley and Breaux. The elderly portion of our population is growing. As you can see on this chart, older Americans numbered about 9 million in 1940. They quadrupled to 34 million by 1995 and are expected to double again to 80 million by 2050. These projections reflect not only the aging of the baby boom generation, but also other important trends. For example, life expectancy has risen continually since the 1930s, when Social Security was created. You can see the evidence of this in the disproportionate growth of the over 75 age groups. Falling fertility rates also contribute. As we'll show you in the accompanying chart, together, these trends are reducing the number of workers supporting each Social Security beneficiary. And here it comes. From 3.3 workers today to 2.0 by 2030. And this mirrors the chart that is to your left. This means, though, that we can't just cope with the effects of the baby boom generation's retirement and expect that things will return to normal, as if that were easy. Increasing longevity will continue to raise retirement costs much higher than the working population can support. And this carries fundamental implications not only for Social Security, but for other forms of retirement income and for our economy as a whole. The long-term financing problem for Social Security also poses a shorter-term, yet relatively hidden challenge for the federal budget. From the Social Security Trust Fund perspective, if no changes are made to the program, funds will be depleted by 2029 under Social Security actuary projections. And it is largely because of this projected depletion that we're discussing Social Security reform today. But from the perspective of the federal budget, the financing challenge comes much earlier, in about 10 years. I'd like to talk for a minute about how the trust fund relates to the rest of the federal budget and how that relationship affects the federal treasury. We have another chart coming that shows that Social Security's cash revenues currently exceed its expenditures by more than $30 billion a year. The trust fund invests this surplus cash in interest-bearing government securities, in effect allowing the Treasury to borrow these funds. In other words, Social Security's excess revenues help reduce the overall or unified federal budget deficit. If the Treasury couldn't borrow from the trust fund, it would have to borrow more in the private markets and pay interest in cash to finance current budget policy. In 2008, 10 years from now, what is now a $35 billion surplus will begin to diminish, and so will its ability to balance the budget. By 2012, where the lines cross, Social Security spending will exceed its cash revenue, and the rest of the budget will have to make up the difference, in effect repaying the trust fund from amounts borrowed previously. So while from the trust fund's perspective, money is still there to pay benefits, the rest of the government would either have to cut spending, raise revenue, or borrow more from private markets to provide the required funding. This relationship between the trust fund and the rest of the government will be important to any decision with regard to restoring Social Security's financial balance. I'd like to move on now to a brief discussion of the ways proposed to achieve that financial balance and how these approaches may alter the current system. Social Security today seeks to balance two competing policy objectives. I think Dr. Greenspan referred to these: social adequacy and individual equity. The progressive benefit formula tries to ensure the adequacy of retirement income by replacing more of low earners' income than it does for high earners. At the same time, the formula addresses equity for higher earners by making benefits increase somewhat with their earnings. A number of options are available to reduce costs or increase revenues within the current system, and as you know, some of these have been used in previous rounds of reform. Some of these available options include reducing initial benefits, raising the retirement age, mandating coverage for all Americans, and these are just a few. Other proposals would address the long-term funding program by significantly restructuring the program, usually by privatizing at least a portion of it. These approaches carry some key differences from Social Security. I'd like to focus briefly on two of them. First, virtually all would require individuals to bear the risks of investing their own retirement assets. Second, privatization would also alter the redistribution of income associated with Social Security because workers would be contributing to their own retirement savings. By focusing on improving rates of return on individuals' contributions, many of these proposals place a greater emphasis on the individual equity objective than the social adequacy objective. Privatization also raises the issue of transition. Financing retirement through individual accounts requires advance funding, and the Social Security system is pay-as-you-go. So even after privatization, Social Security would need revenues to pay benefits already earned. Although the amounts needed to fund both current and future liabilities would clearly be higher than what we collect now, the higher returns of investing the advance funding could help reduce the benefit cuts and revenue increases that would otherwise be needed to close the system's funding gap. Moreover, the advance funding has the advantage of requiring today's larger generation of workers to finance some of their own future benefits now, rather than leaving it to the relatively small generation of workers to come. Evaluating any of these proposals will require assessing potential effects and weighing trade-offs in a number of dimensions. The effect on participants and their income levels would be one. You might ask questions like, how will proposed changes affect workers today and in the future? What about beneficiaries? How will they fare? Are subpopulations relatively disadvantaged? What effects might changes to this program have on other sources of retirement income? The potential economic effects of any proposed reform should also be very important considerations. Reforms could improve the economy's long-term prospects if they raise national saving, and a larger economy would help ease the strains of providing for a growing elderly population. Although there are many factors to consider in this debate, none is more fundamental, I think, than the long-term health of our economy. Interactions with the rest of the federal government, though, should also be a factor. Of particular relevance to this committee is the question of how changes to Social Security would flow through the budget. If a reserve is to be built up, how does the government save it within the context of the unified budget? In addition, demographic trends underlying Social Security's financing problem are also contributing to increasing cost pressures in Medicare and Medicaid. How would changes to Social Security mesh with these future changes to these programs, which to a very great extent affect the same populations? Reform is necessary, and the sooner we address it, the less severe the needed adjustments will be. But as I've noted, any course we take will fundamentally affect workers, beneficiaries, the budget, and ultimately our economy. Despite the need to move quickly, such effects should be well understood before embarking on implementation of any particular reform proposal. I want to congratulate you and the members of the task force for considering these questions early on and for bringing a needed budgetary perspective to them. This concludes my oral remarks. I have a statement for the record, if I could submit it, and I thank you for the opportunity to appear.
Thank you, and we'll include it in the include your statement in the record. Mr. Mulvey?
No, I have nothing further to add except that I think the GAO seconds the comments of Dr. Greenspan that raising the rate of savings is critical to solving the Social Security problem. But we're ready to answer questions at this point.
Stockbridge, did you?
We're ready to answer questions.
Great, thank you. Well, we're going to be looking, obviously, to GAO for a lot of analysis and input on this issue. And I know the chairman of the committee, Chairman Domenici, looks on the role of GAO in trying to analyze this question as being absolutely critical and has mentioned that to me a couple of times. I'm interested in, you mentioned the question of how this flows through the budget. If we were to use the surplus presently generated by the Social Security system and were to specifically designate that surplus for some activity involving Social Security, whether it was a private account designation or maybe start to pre-fund these recognition certificates, if that wasn't Chairman Greenspan's idea, but just throwing that out. What's the practical impact on the budget of using the present Social Security surplus, which is in real terms about, I understand, about $30 billion, and interest on interest ends up being about 80. But what's the practical effect on the deficit and how we would handle that as we look at future surpluses? And just your thoughts on that.
It depends on what's happening in the rest of the budget.
Well, assuming we're going into surplus under CBO estimates, which are going to be for the next 7 to 10 years and which are ranging from 30 billion to 70 billion or something like that.
But it makes a difference, though, because to the extent that the on-budget part of the budget, which is the non-Social Security part, is in deficit itself, removing the Social Security surplus and doing something else with it simply raises the deficit. So I think when Dr. Greenspan mentions this as being a wash, that's what he's talking about.
Right.
It doesn't directly increase saving. I believe it's different if you have balanced the unified budget and have gone further to show a surplus roughly equivalent to the Social Security surplus. That changes many things because you haven't, unless you spend that on some sort of consumption, You spend that surplus on some sort of consumption item. You could view it as investment. It depends on what you do with it and how you deal with it.
Well, if you were to, let me give you a specific example. If you were to take that, let's assume you were running a $30 to $50 billion surplus on the unified budget, and you were to take you were to take the $30 billion of surplus, which is presently in the Social Security Trust Fund, and to rebate that in some way to the taxpayer for the purposes of saving for retirement. Either set up a designated account within Social Security or actually rebate it to them and require them to put it into an IRA account or some sort of retirement vehicle. What would be the practical effect on the budgeting? What budgeting events, fallout, unintended consequences would occur?
I hate to keep saying it would depend. It depends on what you do with Social Security, I think. But if you were to take a budget surplus and turn it, in effect, into a mandated saving program, that, to me, shifts saving from the public sector to private saving. It's saving. As long as the budget remains in balance, as long as you're not removing an equivalent
So it would have no
amount
practical effect
from
on
the
the
economy.
operation of the government.
Assuming it has no practical effect on the operation
And it
of
would
the
have
government.
none if you were
It
running
might
a
have. The
surplus.
reason I said it depends is I was thinking about a relatively arcane issue with interest owed to the Social Security Trust Fund and how we might book that against the rest of the government budget. But it's arcane.
Well, I can't handle arcane issues. I have enough trouble with obvious ones. Now, your projections are the beginning in the year 2008 we confront a fairly significant budgeting issue.
Yes.
Is that correct? Can you sort of explain that to me again in layman's language?
Oh, I'd be happy to. In the year 2008 is a financial turning point for Social Security. Up until 2008, we've been having an increasing or stable cash surplus coming in. More tax receipts have come in than Social Security needs to spend on benefits. Starting in 2009, the amount of that surplus, the nominal amount, is going to begin to decline. Because the rest of the budget has been borrowing that money to finance ongoing spending, the rest of the budget will need to make an adjustment to the decline in the surplus. So it's a fiscal point more than a Social Security reform point that we've been using Social Security's excess funds to finance, which are essentially temporary, to finance an ongoing spending program. And so we'll need to adjust that once the surplus starts to decline, and we'll have to adjust it faster once the surplus has disappeared and Social Security begins to draw money out of the rest of the government. But I think one of the things I wanted to say about 2008, 2009 is that the reason for that turning point is that the boomer generation begins to retire then. That's the very earliest tip of the baby boom generation's wave. And that's a point where we want to have thought, I think, very hard about what we're going to do with this system, because once the baby boomers begin to remove themselves from the workforce, stop paying into Social Security and start drawing money out of Social Security, we've lost an opportunity to get this relatively larger generation of workers to help.
Well, I think that's the key issue, isn't it? But basically what you're saying, we had a chart somewhere where the line crosses in 2012. You had it there, Mr. Stockbridge. But that begins, does it not, once we cross that line and we are actually running shortfalls in the Social Security system, at that point we not only have no money to borrow from it from the federal government, we're going to have to be financing a shortfall, plus we're still going to have to be paying interest on the debt that we've already built up in the system, which is going to compound the problem. And if you look at that chart, the way that line drops in such a radical way, I mean, that's sort of a plane crash chart, isn't it? I mean, that basically means we go straight down as a government in our capacity to manage the system.
Well, and the problem is worse than just repaying Social Security. There's roughly $600 billion in the trust fund surplus right now in assets. But that's not the size of the Social Security problem. You know, as Dr. Greenspan, I think, used the $3 trillion figure.
Is what he used.
That's really the size of the problem. So, you know, when we talk about the importance of this relationship, it's important to recognize, for fiscal planning purposes, what's happening to the rest of the budget. But in some ways, it's the tip of the iceberg.
And of course, that depends upon the assumptions that are being used. If we do have a greater increase in our life expectancies, then the problem could be worse.
So we're talking about a tremendously difficult situation if we don't get on this early, right?
Yes.
We think so.
So do
It's
I.
important. Well, it's important sort of on a variety of fronts. I think I keep referring back to Dr. Greenspan, but I thought he made a very good statement, and he talked about uncertainty. We need to decide what kinds of changes we want to make to a system so people are able to plan. That means that you have to sort of announce it years in advance of when you're actually going to change it. You also want to make changes that will affect saving and economic growth fairly early on. Growth takes a long time. Saving takes a long time to bear fruit. You'd want to do those things fairly early, so you'd give yourself a 30, 40-year lead time to start seeing some of the results of that.
Do you have any analysis of how long it takes to have savings work its way into the system?
Well, our budget issues group at GAO recently did a report for the Senate and House budget committees that talks about the importance of saving to long-term growth. And they demonstrate that you do make significant differences in per capita GDP in the out years by making relatively small changes in public saving early on. And that we've, in fact, made a tremendous amount of progress since they started doing this work in 1992. And initially, they did a scenario that demonstrated if we continued on our current path, things would really start to go horribly awry in 2015, 2020. And we've made tremendous progress by moving toward balance in the unified budget, and that shows in some of the economic simulations that they've done.
Sort of as a last thought here, can you give us is there anything that we as a budget committee should be doing in the form of setting this account up, which would more fully disclose it on the general ledger so that it became clearer what the problem was, or that we could better manage a solution of the problem or better predict the outcome of the problem? Is there something that we should be doing in the form of accounting for this and projecting for this, or just generally defining it within the context of the budget?
Well, I think bringing a budget perspective to this issue is really important. That has been an aspect of Social Security reform that is only recently, I think, getting more attention. You know, when we talk about Social Security, we often talk about it by itself as a self-financing system, which is why we have a Social Security Trust Fund account. I also think that one of the things to consider is that Social Security is off budget. We do have in front of us two ways to think about our fiscal policy. The unified budget deficit or surplus tells us what effect the federal government is having on the overall economy. It's an important number. For the purpose that we're talking about today, you need also to look at the on-budget numbers, the budget bottom line that excludes Social Security, because that tells us that we have a fiscal issue facing us, that we're relying on a temporary source of revenue to finance ongoing spending. And I think continuing to bring both these numbers into the debate would be very important.
Well, I agree with that. I'm just wondering if there's some way we can do it that makes it more dramatic, visible, brings it to the attention of at least the members more effectively, because I do think it gets lost in the milieu of things that are thrown at us. And if you have some ideas in that area, we'd be very interested in getting them.
We'll
As
be
to how
happy
we
to
should set
discuss
up
them
new
with you.
accounts, or maybe define it differently, or project it differently within the statements, or generally try to expand on that. Well, thank you very much for highlighting what I think is a very significant point, which is the beginning in the year 2008, from purely a budgeting standpoint, we've got a problem. And that's not very far away. You know, that's one presidential term away. The next president picks this problem up in the last year of his or her term if he's elected he or she is elected twice. So this is not in the distance. This is at the top of the hill and coming at us. And I think it's critical that we be sensitive to that. And thank you for taking the time to come today.
Thank you very much
Appreciate
for
it.
having us.